Hello everyone and welcome to the video. DQ here for On the Money. In this one I'm going to go through 10 ways for individuals to save tax in 2020. I'll probably make another video down the track that is more for business, but for this one we're going to look at individuals and see what we can do to save you some money. Alright, so let's get into it. Franking credits are also known as imputation credits. And what they are is a refund, a refundable offset on company tax that's already been paid on a share that you are a shareholder of. So when a company pays tax, they record this in their franking account, and then the company can draw down on the franking account by paying out a franked dividend to its shareholders. So this is a record for tax that the company has already paid on their profits. Now the shareholder can then take this credit and offset it against their tax payable in their personal tax return. So the effect is that they're only paying tax once. And this can result in an increased refund on your tax return. So let's look at an example. Okay, so if you receive a $1,000 net dividend here, you have to gross that up for the imputation credit, the franking credit. So the imputation component on that, the tax at 30% is $429. So a grossed up dividend makes $1,429. Now, if you're earning under 37K, you're on the 19% tax bracket. That means because you've already paid 30% company tax on this dividend, you're going to get a refund for 11%. And if you're in the 37 to 90K bracket, paying 32.5%, because you've already paid 30%, on the profit when it was in the company before it was distributed to shareholders, you just have to make up a shortfall of 2.5%. So next up we have trusts. A trust is a type of a business structure that is often used for business, of course, but it can also be used at the individual or family level. Individuals or families will often use them for holding assets such as shares, your portfolio, as well as rental properties. They're great for protecting family wealth, or any wealth for that matter, but another thing that makes them attractive is that it gives you the ability to split income across multiple individuals, or beneficiaries as they're called. So you've probably heard of a family trust. Well, family trust is usually what's been referred to as a discretionary trust. And the basic premise is, without getting too caught up in the detail, that'll be for another video, that the trustee, this is the person or the entity that controls the trust, has the discretion to split up the income in the most tax effective manner. So you might send more money to people on lower tax brackets to utilize the lower marginal tax rate. So this can really come into play if you have a partner who's on a lower income, or maybe have some adult children who they might be in university and working just a part-time job, or not working at all while they study. So you can really utilize the tax-free thresholds with these other earners and bring down the overall tax bill across the family unit. Okay, so if you have a primary earner and they're earning $70,000 from their job, and they also have investments, they might be dividends or rental income for $30,000, that makes a total income of $100,000. The tax on their job, 70 grand, is $14,600. But the total tax, when you add in the $30,000 investment income, is $25,700. So that means for the $30,000 of investment income, they're paying $11,100 tax on that. Now, if you have a trust, and say you have a partner who's working part-time and earning $30,000, you can distribute 10 of that $30,000 to them, and this is how much tax they'll pay. And you have an adult kid who's working part-time also, earning $20,000, you can send $10,000 their way, and that's how much tax they'll pay. And you have another adult kid who might be at university and not working. You can throw another 10 their way, and because they're under the tax-free threshold, they won't pay any tax at all. So when you add up all the tax on the investments, the $30,000, you end up paying $4,400 in tax. When you compare that to what the primary earner would have paid on the $30,000 investment income without a trust set up, they've saved $6,600. So as you can see, if there are some beneficiaries who are in the lower income brackets that you can distribute some of the trust income to, you can save a lot of money. And even if all the beneficiaries are earning over 37K, so they're paying 32.5% tax or more, there's still an opportunity to save tax here by distributing income to what's called a bucket company, which is basically a company that is a beneficiary of the trust, which allows you to distribute money to this company to utilize the lower corporate tax rate. But this is a more advanced strategy, so you definitely want to speak to an accountant who can assist with business structuring and tax minimization if you want to look into that. So with the great lockdown of 2020, this has forced a lot of people to work from home who weren't previously working from home, and this means that they're potentially using more electricity, water, gas, etc. in order to derive an income. So because of that, you are able to claim some of this as a home office expense. There always has been the ability to claim a portion of your home office expenses if you're working from home for an employer or running a business from home. But what the Australian government has done is introduce a new shortcut method, which allows you to basically log the time that you're working from home, and this will be used to claim a portion of your utilities, phone and internet, office supplies, equipment, and any office furniture like a desk or a chair. So what they've done here is they're allowing an 80 cents per hour claim for every hour worked at home from the March to September 2020 period. Now, because this covers only March through to September at this point, and that may change, but that's where it stands at the moment, you're going to have to use a different method from July through to February if you're looking at your 2020 tax year. So you might use the existing fixed rate method, which is 52 cents an hour, but you have to be a little bit careful here because it does work a little bit differently. For example, this won't include your phone and internet expenses. Another way is to claim a portion of the actual cost of your work from home expenses. But this can get a little bit more tricky in regards to how you go about substantiating your claim, and it's usually used by people who have a dedicated work from home space, such as a home office that is separate from the other areas of the house. Okay, so with an offset account, this is an account that's attached to a mortgage, which allows you to, it's like a regular bank account, but allows you to park cash in this account, and this cash is then used to offset the amount of interest you're going to pay on your loan. So if you have an interest-only loan and you have money in your offset account, this will work in a way that will reduce your interest payable, so it will reduce your monthly payments. Or if you have a principal and interest loan, your repayments will stay the same, but by reducing the interest component, it'll increase the principal paydown component. Offset accounts are great because the interest benefit is tax-free. This is because technically what you're getting is a reduction in expense, so there's no tax payable on that. But if you had that same amount of money sitting in another account, but instead of being an offset account, it was a regular interest-bearing account, a deposit account, you'd be paying tax on that. The other good thing is that the benefit by using an offset account will be higher than if you had that money parked in a interest-bearing account, like a savings account. This is because generally always the interest rate on a loan will be higher than the interest rate on a savings account. I went into a lot more detail on this, as well as giving options for parking cash in certain situations in another video. So I'll put a link up here or wherever it is. So check that out if you're interested in that. Most people will pay their Medicare levy, but if you're an individual earning over $90,000 a year or a couple earning $180,000 a year, you will also be liable for the Medicare levy surcharge. And this is levied at between 1 and 1.5% on your taxable income. But if you have private healthcare that has an appropriate level of private patient hospital cover, you're exempt from paying the Medicare levy surcharge. And what has happened is that a mini industry has sprung up around this particular issue because a lot of people, their primary motivation when they get to that 90,000 point was not necessarily to take out private health cover, but to save on tax by not paying the Medicare levy surcharge. So a lot of insurance providers have started offering what have become known as junk policies. And as a result, many of these cheaper or junk policies didn't provide a very high quality of health cover at all, and left the consumer having to still pay out of pocket expenses when trying to cover themselves for medical costs. So be a bit careful if you're looking around for a private health policy. It actually became a pretty big issue to the point that there was a Senate inquiry held into the matter. Okay, negative gearing. We hear a lot about it. It's definitely not without its risk, but there's definitely some decent tax breaks on offer as well. The basic idea is that you have a rental property usually, and you make a tax loss on that property, and you then take that tax loss and you use that to lower your taxable income. So you offset it against your other income such as your job. Now, because that brings your taxable income down, it means that your tax is lower on your job than it otherwise would be. It works better in certain scenarios than others, and there are definitely pitfalls you have to look out for. So if you want to learn more about negative gearing, I'll put the link up here. Check it out. A lot of younger people don't like putting more money into super than they have to. But if you can afford to, there are substantial benefits on offer to doing this. One way to take advantage of this is through salary sacrificing. This is set up by your employer, but not all employers will offer it. Basically how it works is normally, you have your job income, tax comes out, and your employer pays you what's left over. With salary sacrificing, if you're, say, sacrificing $10,000, they will take $10,000 out of your gross wage, send that straight to your super fund, and then tax you on the balance, which will be a much lower amount. So there's no tax on that itself, but when the money goes into the super fund, 15% will come out, but in most cases, 15% will be a lot lower than your marginal rate that you'd be paying on your other income. Now, in this example, if you're not using salary sacrificing and you have a salary of $70,000, you're going to be paying about $14,600 in tax. Now, if you decide that you want to salary sacrifice $10,000 into your super and your employer allows you to do this, what they'll do is they'll take out over the year $10,000, send it straight to your super fund, and you will have to pay 15% tax on that when it goes in. But as far as income tax goes, you're left with $60,000 taxable income, and your tax on that will be $11,000. So you've saved on income tax $3,500. Another way is to make a personal contribution out of your after-tax earnings and then claim that deduction on your tax return. You're allowed to contribute up to $25,000 a year, so that's essentially a $25,000 tax deduction on offer, but this does include money already paid to your fund from your employer, so you have to take that out when you're working out your $25,000. You can also now carry forward unused portions from previous years, so there's some really good opportunity there to get some really solid tax savings. This is one of the best tax deductions on the block. Not only do you save really well on your tax at that time, but it also allows you to build wealth by pumping money into your retirement fund so that this will compound over time, and then when you retire, you will be very happy. Capital gains are taxed a little bit differently to your regular income, and there's a couple of ways that you can plan your asset sales to save on your tax. Firstly, if you own an asset for at least 12 months, and this might be a stock or it might be a rental property, you're eligible for a 50% discount on your CGT, your capital gains tax. Now this means that if you're in the top tax bracket of 45%, you're only paying tax on 50% of that gain. So effectively, you'll only be paying tax at the rate of 22.5%. And this is one of the ways that the rich keep getting richer. Another thing you can do is that if you have some dud stocks that haven't done well, they're trading at a loss, and at the same time you have something that's done well and you're selling it for a gain, you can sell those dud stocks at a loss and use that loss to offset against the gain to reduce your total capital gain. And also because you can choose when to sell an asset or when to hold it. So if you have a bit of an idea that maybe next year, for whatever reason, your income might be a bit lower, that would be a good time to offload assets. But if this year, if you're having a really good year with your job or whatever, and you're getting a lot of bonuses, you've got a high income, this is a year that you wouldn't want to offload assets that are made a gain. So the goal here is to basically, if you can, it's not always easy, but if you can, sell your assets that have made a gain in a year where your marginal tax rate will be at a lower point. Okay, so this one all centers around your principal place of residence, or your primary residence as it's sometimes referred to, and the capital gains exemption that is attached to that. Now, because there's no capital gains payable on your home, your residence, it's tax-free, one strategy is to pump as much money as possible into your home, and then if you sell down the track at a big gain, that is completely tax-free. Although I should add that if maybe you're running a business from home, or doing some subletting and this kind of thing, this can sometimes affect your exemption. Another thing is that because there is no tax deduction for interest on the mortgage for your home, it makes sense to concentrate on paying this non-deductible debt down first before you look at paying down your deductible debt, such as debt on an investment property, so that you can maximize those tax deductions for a longer time. Okay, we've been through a lot here, and I've only just skimmed the surface, but at least you can see what might be applicable to you, and you can take that and you can continue your research. However, if you just want to check that you're on the right track, or you want to make sure that you're getting the biggest possible refund that you can, consider hiring a good accountant. In most cases, an accountant will pay for themselves. The money you're paying them is fully tax deductible, and they're going to ensure that you're getting all the deductions you can. They're going to maximize your refund, but they're also going to make sure that you're not attracting any undue attention from the tax office. They're going to keep your audit risk low. Now, if you've already got a good accountant on board, that's great. If you don't and you're looking for one, check out the link in the description, quintrell.com.au. And that's it, guys. So thanks a lot for watching the video. Let me know in the comments section what you think about these tax deductions. If you've got anything to add, please share. If you've got some value from the video, hit the like button. If you want to see more on business, finance, tax, etc., hit the subscribe. And that's it. We'll see you in the next one.